Welcome to So What's It Actuary About? I'm your host, Margie McKechnie, and I, along with my wide array of guests, hope to help you better understand and weather the wonderful world of actuarial science.
Hello and welcome to today's episode. I am joined by Nadeem, who I worked with at EY, and he tells me that he is the best dressed, actually, not Amor. Are we still friends?
We are. The thing about bespoke suits is they speak for themselves.
Okay. So Nadeem is choosing aggression today. Nadeem was also one of my colleagues that called me Magrat, and has for the past, 6 years. So that's been an interesting journey. But let's put that aside. Thank you for being here. I so appreciate you taking the time. Will you tell us about your journey to becoming an actuary and why you became an actuary?
I'm still wondering about the why, and I can take you through the journey. So at the end of matric, I had okay marks, and I was really unsure about what to study. I was very torn between, do I go to AXI, do I do aeronautical engineering, do I go into medicine? And the way I picked AXI was by going, well, if I don't like this, first year AXI gives me the most options if I move into something else in second.
Which is like a very actuarial way of looking at it, actually. Like, what options do I have?
In hindsight, yeah, I was managing the risk, reducing the cost of failure in that case. And I found after first year, I quite enjoyed it. I was okay, let me keep going with this. And that was most of the undergrad, enjoying the technical stuff. And then we got to honors, and you kind of pivot away from the very technical things.
Different. Like chalk and cheese almost.
To a very application-based. And that's when I really started to laugh. And I was like, okay, maybe I should, work in the space and finish.
Yeah.
And that was well.
And tell me, what were your chosen F100s, like the speciality that you do towards the end?
Sure. So in honors, of the, I think we've got 5 different options. I picked short-term insurance or general, non-life, got many different names, and investments.
Okay. And why did you choose those?
Ooh. Again, I think they gave me the broadest range of tools.
Okay.
So as an example, life and health, that's a great combo in honors because they're quite similar.
Yeah. They call it the 1.5 exemption.
Yeah.
Which is what I did, which I feel like I'm a little bit attacked when people tell me 1.5 exemptions. Yeah.
So I didn't really want to do that with things that were too similar. I wanted to take things that were quite separate. So something on the asset side, investment, something on the liability side, short-term insurance, which...
Okay.
Yeah, I think my view was life insurance is a really well-tread path for actuaries. So I wanted to do something a bit outside of,
Perfect. That makes sense. So tell me then, after honors, what was your career path and why did you choose the sort of various jobs that you ended up working at?
Sure. So I started at EY consultancy, and I think the big advantage you get when starting a consultancy is you see a range of problems or the same problem at different clients. So if you go into a corporate and you work in reserving, it will be quite tricky for you to get experience in pricing and capital. It can be a bit difficult to move around that much within the 3 years. And why do I think it's important to move around? Because for the fellowship exam, it helps if you've actually worked in those areas.
Yeah.
So that's why I was very keen on consulting, and EY in particular, I felt like I really enjoyed the culture there, the fit. So that really drew me to EY. Towards the end of my about 3.5 years there, I was like, consulting is great for developing a breadth of skills. What if I want depth in one area? So kind of the exact opposite now. I was about to run my fellowship then. I was like, maybe I should go and learn a specific skill a bit more deeply. And so I was looking at moving to another insurer the time, and there was a last minute opportunity presented itself, and I ended up going into a completely new thing, banking and investing. So it wasn't really planned, but the opportunity arose, and I felt like I wouldn't really get a chance to completely shift industries.
And tell me, banking is quite a new space for actuaries. Can you just speak to what actuaries really do in that space and what sort of value they add?
Yes, I feel like as an insurer, everyone knows, okay, here's the actuaries, here's what they do. They're kind of scattered everywhere. There's wide presence, but in banking, much less so. Some banks in SA have a higher presence for actuaries than others, but for the most part, they're not nearly as common as they would be insurers, and that just speaks to the nature of the work. I mean, in an insurer, there's very well-defined processes around reserving and capital management specific to insurance risks, so actuaries are strong there. What happens is in banking is they do the equivalents, but in a banking framework. So I guess the equivalent of reserving would be your credit risk modeling, which not really an area I'm involved in, but I've looked at briefly. And then similarly on the capital management side, maybe doing some liquidity modeling as well. So within banking, I'm not a traditional banking actuary. I'm not really in any of those areas. I'm in what we are currently called, is a bit unsure, but so, yeah, to decide our new name. But it was formerly called the analytics consulting team. And what we did, we served as an internal consultancy, and wherever the business needed insights from data to help inform their strategy, be that anything from new product launches to new target market segments to just any, I guess, business case or changes that they're looking at making, we get involved in assisting with that.
Okay. And have you found that to be very different to what you anticipated? Or is it constantly sort of changing and you constantly pivoting and sort of seeing businesses in new ways?
Yeah, so that's the nice thing about being in this sort of internal consultancy space, because if I compare to when I was in pure consulting and going to different clients all the time, being at the same place and having one company that you focused on really allows you to learn that business quite deeply.
Yeah.
So I think I add much more value than I would as someone popping into the business, getting whatever data and context I could, and then, going on to the next project. So I think that depth of understanding and knowing who to speak to when you're uncertain about different things, that's really useful. And being at a corporate has, allowed me to have that. But at the same time, there's the benefit of consultancy in that we're always doing different projects. There's different problems all the time, and that keeps me from getting bored because there's a variety of work.
But you wrote your fellowship in general insurance, right?
Yeah.
So, and did you write that while you were working at bank?
So I wrote it 2 weeks after I joined. I joined on the 1st of April. I took 10 days of study leave, and then I wrote my paper, and then I actually started working after that. So it was just because of the timing of the move, it worked out that way. So I went into fellowship having only effectively worked in a short-term space in the consultancy.
Okay. And how important do you think it is from a fellowship perspective to work in the space that you're writing your fellowship in?
I think it makes it significantly easier. So in my fellowship paper, there was a question about doing reserves for an insurer that is in runoff. And that's a very unusual scenario. In SA, there's maybe been, I don't know, a handful in the short.
Can you just explain what that means to our
So
listeners?
basically, something has happened in the insurer space where they are either in distress or perceived distress. They're not necessarily meeting their capital requirements. And it's not that they are technically insolvent. They have enough to pay their current claims, we'd hope. It's a bit easier to assess in the short-term space than in the life space. But at the same time, the future viability of the business is in doubt. So they were entering what was called runoff. They were going to wind down their operations.
Okay.
So they needed to continue to pay claims for any claims that, were lodged in the time, but slowly close or wind off or shift or run down their book.
Okay.
And then possibly sell it off to another insurer.
Okay.
Yeah.
Okay. And the question that you were asked in the fellowship was specifically on that scenario.
Yeah. And that was such an advantage, having worked on something. I mean, you can study something and, a chapter in the notes, maybe spend 10 hours on it. Having worked on it for 80 hours is
Understand complexity.
different depth of understanding. And I saw that, I grinned because, if it's a 15-mark question and you can do it in 10 minutes, it's if that's free time.
Yes. And it frees you up in other spaces that you maybe look at a question and you're like, okay, I'm not sure about the scenario.
So that was critical. We had questions on capital modeling as well. That was, again, like an area I'd spent a lot of time working on. One or two small things on pricing, having looked a bit at pricing really helped. I think it would be very difficult to write fellowship and get it your first time without having some actual, I think, work experience in there. It's possible. People have done it.
Yeah.
But
it's more difficult.
Definitely more difficult.
Yeah.
So I was quite lucky. I got it first time. And I think a big reason for that was
with having exposure. And tell me, I mean, you've mentioned capital modeling. For our listeners, what exactly does that mean?
Okay, so in the normal course of an insurer's business, there's a fairly known amount of money that they could owe in the event of claims. And I say fairly known because in extreme events that changes. So take a simple motor insurer as an example. Across 100,000 cars that they might be insuring, it's pretty well known how many accidents you'd expect.
Yeah.
But let's say a severe hailstorm sweeps through and a lot of their cars are on the roads at the time, and suddenly you have a surge in claims.
Yeah.
Capital modeling is to make sure that the insurer has enough money to support that excess of claims. So these events don't happen all the time.
Yeah.
And what insurers try and do is they keep enough to support themselves through what they call a 1 in 200 year event. So such an extreme event that it's very, very unlikely to occur. But if it does occur, the insurer has sufficient assets, less their liabilities, to support it. And it's quite nice because you look at both the example I gave with the liability side, but you can also look at the asset side. If the insurer has the money that they collect from premiums and they take that and they put that in banks, that's great. The banks are fairly secure. What if one of those banks falls over?
Yeah.
Do they have enough money, even in that case, to still support their claim?
Yeah, which is their obligation, right? And the regulator's going to make sure that they honor that.
Yeah.
Yeah. So you also spoke to, just tracking back to something you said earlier, you spoke to having done general insurance and having done investment for your two F100s. Why do you think it's important for actuaries to have an understanding of the liabilities and the assets? Because I think as actuaries or as actuarial students, we focus on the liabilities a lot because that's what we're managing, right? But why do you think it's important to also understand the asset side of it?
So I think it depends on what you want out of studying actuarial science. The way I viewed it was that I'm getting a tool set of skills that I'd like to apply in many different contexts. So my worry is if I only understood the liability side and you design a product, you need to know what are the appropriate assets that we could. So any insurance product works, but you collect premiums, you invest them in something to grow, and as claims arise, you take it out of that thing to support the claims.
Yeah.
If you're designing cool or interesting products, you often need interesting assets to support them. So it doesn't help putting all of your money into cash at bank where the interest rates are maybe a bit lower. So you need to look at bonds. Bonds are great, but what if you have a liability that's in dollars?
Yeah.
It can't be an SA thing. You have to match the currency as well.
Yeah.
So let's find a dollar asset. Now you're taking currency risk. And I thought by understanding the investment side, you can create products that are much more competitive because instead of relying solely on premiums and a low amount of growth, you're also able to use investment returns to either enhance returns to the company or offer more competitive pricing. Probably a mix of both.
Which links very much to that sort of asset liability matching that we introduced to an actuarial risk management and honours. And you said that you really enjoyed honours because it gave sort of a lot more background to all the technical work that you've been doing. Can you speak to how important that is? I think, a lot of students just see actuarial science as maths. And how important it is actually to see it as part of a broader ecosystem. And we're actually business people. We're not just these mathematicians. Otherwise, we'd be called mathematicians.
Yeah, so in my current role, I work a lot with data scientists. And a very common debate we have is what the right question is. Because often they'll come to me and we'll be discussing something. They'll be like, how can we do it? And I'm like, the question is, should we do it?
Yeah.
Because often there's business contexts and reasons where there might be benefits to a new feature being developed, but there are also risks and costs, and you have to be able to weigh those out before you go and invest in developing this. So I think honors is really important in giving you that ability to step back and go, okay, great, we've learned all of these technical tools. Now, so what?
Yeah.
I can calculate how long we think it is until a light bulb fails.
Yeah.
So what does that mean if I'm working in a very different context where I'm optimizing process for a factory, So it's expensive to go up to the roof and change one light at a time all the time. Can we create a cutoff where when 30% of the lights fail, you just go up and you replace everything because that actually reduces the cost.
Yeah.
The kind of tools that you get can be applied to anything. It was a very random thing I picked, but that's pure survival model analysis.
Yes.
You can use that for human lives. You can use that for failure rates on components. You can use it for motor warranty insurance. You can use it for other sort of claims and failure processes.
So I think it's interesting because it's only elements of context that you get later on having studied. And I think it would be quite helpful to get that earlier. But I guess it's like a chicken and egg situation in that would you have understood it earlier if you engage with it at university, like in your first couple of years, because you just don't have the technical skill to even understand what you're doing.
Yeah, it's quite tricky because I think in second year is that we do that very small business applications course, and that's kind of the first time you get a bit of sight into, okay, this is how the stuff is used. You get it as you learn the tools, but I think if you hadn't learned them, you wouldn't really appreciate the difficulty of the application.
Yeah.
It's easy to decide when to change the lights in a factory.
And that element of optimizing, right? Yeah. And understanding that there's certain points in time where you can manage things best. And I think that's something that actuaries don't always get right, but try to sort of way in.